Good afternoon and welcome to today's presentation of our bond fund. My name is Elcar. I'm the CEO of East Capital Group, and with me today I have Stefan Pari, responsible for our bond fund. Today is the first in a series of 4 presentations that we will host shortly with an update of our 4 strategies within East Capital Group. The next one will be this Thursday at 2:30 Central European Time, focusing on global frontier markets. Before we start, I would like to encourage you all, if you have questions, please write them in the question and answer focus on the screen so that we will take it on live. Our Nordic Corporate Bond Fund was launched towards the end of last year. It's been an absolute success. It's been based on a number of cornerstones, which very much in line with Stefan's way of running money, but also very much in line with the way we run money overall in East Capital Group. It's based on high quality holdings. It's based on a low risk, conservative stance, and it's very much based on our own research. Stefan does his own credit research, which is really unique. It's been highly successful 6 or 7 first months for Stefan in the market. So I have the first question to you, Stefan, basically say, could you elaborate a little bit on the main things that are taking place during the first 6 months, and maybe focus a little bit on the banking crisis in the US, as well as the real estate problems we've had in Sweden?
Of course. Yeah, it's been an interesting time, but if we just talk about when we launched the fund, we saw the last year with raising interest rate and credit spreads widening. So at the time of the launch and we started investing, we were a little bit selective when it comes to what to invest in, and we foresaw that the interest rate would continue to climb. So we needed to invest in companies and issuers that had some resilience or even benefited from a higher interest rate. So it became clear that we should invest more than we first might think about in banks, because they were beneficial when the interest rate was higher. So we had an overweight when it comes to bank compared to almost all of the fund, and an underweight when it comes to real estate, because that was a sector we saw that would be particularly hard hit in a higher interest rate environment. And that went well until the banking crisis. And you saw especially subordinated debt widen significantly in March. What we did, and based on the credit assessment we had made on the bank and the regulating environment that the bank is working within, we actually increased our exposure even more during March, which was good. So we had almost 20% of our funds in subordinated different kinds of bank debt in very stable, big Nordic banks. And since then, those 20% has gone down to around 8% today. And we still remain cautious when it comes to real estate, even though we have seen some things in some real estate companies has managed to invest or work through, especially the financial problems that they've had. But we remain underweight for now.
Stefan, are there any particular cases or companies you would like to bring to our attention that really stands out when it comes to the way you run money and the cornerstones of our investment philosophy?
Since the beginning, our largest holding has been Open Infra, and that's a secured bond, and it's secured by the infrastructure, broadband infrastructure that they actually manage and put into the ground. And our assessment is even if you would have a bankruptcy in the company, you would have a recovery of 100%. So and when it's still a going concern and we don't see any signs of anything else, you would have a yield of around 8% currently. So that's interesting still.
Well, that's great. I mean, we've seen the the performance you've had, it's been outstanding, and we've seen huge interest from investors, both domestically as well as international. So that's basically behind us. Now we're in through the summer, the Nordic markets are up, the European markets are up, we're back from vacation. Could you elaborate on what you see for the remainder of the year, an update on the strategy, and you see what are the main events taking place throughout the fall?
Yes, but the issuance has really started to kick off. You see a lot of companies that for a year has been shut off from the market. They have entered the market, and you have a large inflow into several fixed income funds that can meet the demand from this kind of companies. And I expect the spread tightening to continue to generate a positive return. And if things continue in this direction, there might be some companies that are still locked out from the market. They might be welcomed in, and that would solve a lot of problems, especially in the real estate sector. But we're not there yet. So we remain cautious still, and if we look at the risk we are taking, we are taking a little bit less credit risk than we initially foresaw that we long term should have, and that's because we think that the bankruptcy will continue to go up, and that's not a Nordic phenomenon. That's a global phenomenon. And we expect that to increase in until next year, maybe in the end of next year, until that flattens out. So there is not that much value in taking risk by investing in the highest risk credit at the moment.
And the defaults and bankruptcies is the main concern.
Yes,
running the money in the bond fund.
Yeah, because your upside is capped. You get the coupon, but if the company goes bankrupt, that will really deduct performance from the fund. Yes.
Right. If you're looking on the maturity of the fund or the portfolio, I mean, I know when we launched it, you had a reasonably short maturity given the uncertainty regarding the macro environment, interest rates, and so forth. What's your view on that? Yeah,
it's still short. But whenever we think that visibility is higher, we tend to prolong the maturity by investing in longer bonds. So, for instance, Swedbank's for one, we've invested in some bonds there that are fairly long, 2029, for instance, which is long in a Nordic context. And when the visibility is shorter, we try to be shorter as well, because we need to be able to predict the swings in order to do our job in a correct way.
If you go back to the allocation, you mentioned banks, you mentioned the real estate sector, but going forward, given the environment, the macro environment, given that this is not a Swedish bond fund, it's a Nordic bond fund, how would you rate the allocation, both from a sector point of view or industry point of view, but also from a country point of view?
Yeah, it's interesting because there is different kinds of investors in the different countries. We predominantly invest in Swedish companies if you look at the portfolio as a whole, but a lot of the Swedish assets is in investment grade rated companies. If you look at the high yield companies, then you would see that you would have a more exposure to Norway and Sweden, as well as some in Finland, and which is very, very good because we could sell or buy different kind of assets or bonds in different countries based on flow risk, because the price is flow driven in the Nordics to a large extent. So by being able to invest in different countries within the Nordic region, we might generate alpha just by investing in different countries. Yeah.
We're here in Sweden, we're constantly reading about the foreign concerns about the Swedish krona and what's happening in the real estate sector. Could you elaborate a little bit on the foreign interest in the Swedish bond market and what the effects of that actually is?
I would say that the foreign interest has been tremendous, and that's partly because last year the interest rate environment went up, or the interest rate went up, and if you look at the fixed income fund in euros or in dollars, due to their fixed nature, the performance were not very good. I think in general the performance was between -15 and 25%, depending on what kind of fund you were looking at. And the Nordics managed quite well, even in 2022, even though we had credit spread widening, because we had so much floating rate notes in the system, meaning that the coupon would actually float according to the interest rate environment. So when interest rate went up last year, you would actually have a higher coupon on the bond. That was something that makes this market a little bit unique, and it's also something that has made this market very interesting for this kind of investors looking for a kind of product that is a little bit different compared to dollar or euro denominated European or US funds.
You already mentioned the bankruptcies and the rate of defaults going up in Sweden. I see one of the questions here on the screen is basically, could you elaborate a little bit on that and how you basically, when you see these numbers going up, what's your analysis of what sectors and how in any way does it affect your fund and the way you basically allocate new money?
Yeah, well, we are assessing both the issuer itself, the company, but also the bond and the documentation around the bond, the term sheet. And we try to assess the industry risk. We try to assess the value chain and where the company is in that value chain and the kind of power that company has together with the other companies that they interact with. So I would say that it's a case-by-case basis. We don't just invest, but we look at, okay, either you have a high recovery and low probability of default. Either one of those are something that needs to be there in order for us to invest. Preferably both. That would be the best. And then you look at the environment we are living in, and you see that the bankruptcy, just like you alluded to, are going up. And that means that the credit risk, because the credit risk is a factor that determines the bankruptcy risk, right? So then you try to mitigate that by having a little bit higher credit ratings in the holdings we are investing in. And that's something we do. And if we think that we go into an environment where things are looking better when it comes to bankruptcies and companies are making more money and the consumer are starting to spend more money because interest rate going down or salaries going up, then you could increase the credit risk. But that's at the moment we are cautious.
One of the things people ask me when they meet me, say that Stefan does his own credit research. Basically, could you just spend a few minutes? How is that actually done? How do you do that? I mean, the local touch, getting out there to meet the companies, meeting management, seeing what the environment competition is doing and so forth. Could you just illustrate a little bit what actually takes place?
First of all, it's super important to know the company. So in general, we meet the management of all the companies we invest in, just to understand what are the drivers, why do they do what they do. And we try to assess the board, we try to look into the owners, and then we do try to do this traditional credit analysis that in some ways looks similar to what Standard & Poor does. So we look at the operational risk and the financial risk, and then we break it down into several metrics. And we evaluate the financial policy, we evaluate pricing, something that the rating agency doesn't do. And what we do that differs very much from the rating agency is that we are actually doing a recovery analysis that is very fundamental in order to for us to see if we would invest or not invest. What a traditional rating agency do is they make an issuer rating, and then they make a bond rating, and the bond rating is anchored to the issuer rating, and it goes up or down or it doesn't move at all based on a recovery analysis. But that means that even if you have a very, very good security attached to a bond, but the issuer itself is low rated, then the bond will be low rated, even if there is a tremendous value in the security. And that is one of the things that we think is wrong. And we try to look at the security, the value of the security, and if that is high enough, and they are forced to pay as if it would be low, then it might be an overweight for us. But that depends also, of course, on other things.
Mm-hmm. I know this is impossible to answer, but I'm going to ask you the question. I mean, you said the primary market is taken up, some more volumes going after vacations. Are there any particular industries or sectors that you expect, and not on a company specific level, but on an industry level, do you expect to attract more interest or draw more capital from the market?
I think the easiest answer here is the kind of sector that will benefit or having an easy way with a higher interest rate, and that's predominantly banks or debt buyers, for instance. But it might also be companies that actually need to get bond issuance or bond capital from the bond market. So I expect some real estate companies will be out there, but they might pay a hefty premium compared to what they are used to. And that is something that fundamentally might not be very, very good for the equity price of this real estate company. But if you don't have any choice, then you need to pay up. So
that's what we have to wait for.
Yes.
All right. I think we're drawing to an end of this presentation. And I think you will agree with me that I mean, given the much higher interest rate level environment we're in now, and we foresee that we will be for the foreseeable future, at least compared to the last 5-10 years, the interest, we've seen an enormous interest in our bond fund. We've seen, as I said, both retail, institutional interest here in Sweden domestically, but very much international, where they think the Swedish Nordic industry is highly regarded. We have a strong banking industry and a pretty good sound economy to back this up. We continue to see very interested investors, and in that context, the value of running the money the way Stefan has described, the way he does, our own research, being conservative, we think adds a lot of value. So we remain very positive for this market, and please, if you have any questions, direct them to Stefan or his colleagues. And with that, I would like to thank you, Stefan, and you all for taking part of this meeting. Do not forget on Thursday that we had the Frontier Market update at 2:30 Central European Time. Thank you and goodbye.